Hey, do you sometimes wonder, what am I really going to be good at? What really feels right? How can I do a job and find something that I'm really passionate about? Today's guest, Brad Shepherd, is one of those people who very early on, while he was still in college, got introduced to real estate and he dabbled in it and he got really, really curious and started to learn more and more about it. And in that process, became familiar with what he really likes about it. And now, and in our episode, he's going to tell us how to become a capital raiser for syndications, and he will explain to all of us what that is. But most importantly, I think it's really important for you guys to pay attention on how do you find your passion. Hello and welcome to another episode of the Ideal Investor Show. Today we have a great guest. Brad Shepherd is with us, and we want to talk a little bit about passive and active investing and the kind of investments that he has done and the experiences that he can share with our audience so that we can all learn a little bit on what are the different ways on investing in real estate. So without further ado, Brad, welcome to the show.
Hey, thank you very much for having me. I'm excited to be here.
Yeah, awesome. So talking about that, you have had a pretty interesting journey. I know from a little bit of research that you kind of got interested in financial and money things and real estate really, really early on. I think I saw on your website, though, basically coming out of college or maybe even already during college from what you were studying, I think financial services or stuff like that. So can you give us a little bit of a synopsis how you went through these different phases to get to where you are now?
Sure. I'll give you the quick version. I'll do my best to be quick. We'll see if I can do it. I think it was in high school when real estate caught my attention. Started reading Business Week and joined the little, high school club, Future Business Leaders of America. I wanted to see my name in Business Week. I wanted to see my name in the Wall Street Journal or what have you. I didn't know how to do that. I didn't have a great plan, but I started reading more along the lines of personal finance and growing capital. Eventually, rich dad, poor dad, like so many people, but at a relatively young age. I went into college with the idea to major in finance and then go into commercial real estate profession. So my internship during college was actually with a large commercial real estate operation. They would, they buy and develop and operate shopping malls and skyscrapers domestically and internationally. So it was an incredibly fun internship. Came back from that and life took me in a different path. I joined a young startup. I was employee number 2, a much different setting than what I had anticipated. But by the time I finished college, I had been with the company for a couple of years and I was running a good chunk of it, and we were having a blast and making some cash. And so it was a decision point that I made and stuck with that little organization, and it turned out really well for me. But along the way, I had not given up the idea of I knew real estate is a phenomenal tool. I felt like I could figure it out. So I picked up rentals. I bought my first condo. It was actually my partner's money. He did the financing for me. And I thought, okay, I can buy a condo. Here I am, a young kid right out of college with nothing to my name, no credit. I figured out how to buy a condo using other people's money. How can I do this more? But we had fun with that little company. I bought some more personal rentals, but with that company, we also started doing some development, vacation rentals. Before there was such a thing as Airbnb, we kind of figured out how to do long distance vacation rental management. We built a little hospitality building that had hotel suites on top floor, retail on the ground floor. We bought a neighboring little 15-unit hotel building right next to that one. So we were involved in real estate, even in that little company. So that was really fun for me. When we moved to Austin, it was, that's where I started doing some more of the active fix and flips, wholesaling type of deals. And that eventually led me to, why am I doing this? Stuff is hard. It's hard to find these deals, talking to these individual sellers, managing contractors. Right. And finally the light bulb went off. Why don't I go back to commercial? And that was maybe 2017. And I kind of paused, looked around again. Where do I want to be? And large commercial opportunities floated to the top for me. And that's where I've been focused ever since, for the last 5 years or so, really targeted into the large commercial syndications. And where I've really enjoyed my role is primarily as a passive investor and helping other people participate in these great opportunities that I've been able to identify. That was not as short as I was going for, but hopefully that gives you a sense of my journey.
I'm sure you skipped a bunch of steps there. And yeah, I'm really grateful for that little summary of the journey so far. One of the things that I hear from our community, especially this year so far, is that there has been over many years this almost, I'm tempted to say, spreading the Kool-Aid in a sense to say, well, investing isn't really that hard, like you can do all these kinds of different things. You can do NFTs, you can do stock market, you can do life insurance, you can invest in art, or you can invest in wine and whiskey, or you can do crypto. And it doesn't really, I mean, they didn't say it quite that facetiously like I'm doing right now, but basically, it doesn't really matter necessarily
Because it's all going to go
what
up.
it is. Everything is going up. It's the old mantra that things ever wouldn't go up doesn't exist anymore. Look at the results of the last, 5 years, 7 years, 8 years, whatever.
Right.
And then basically the end of last year came along and it's not really like that anymore. So if you take that platter of fruit, so to speak, that has been presented to us, how would you describe it if somebody says, okay, so you obviously are very committed to real estate, just like I am, and we are at the Idea Investor Show and Idea Wealth Grower, but why real estate and why continuing with real estate?
Yeah, it's been so interesting to watch that journey. And there are, I've seen friends and acquaintances making great money on NFTs, which I don't really fully understand, and crypto, which I don't fully understand. I kind of get some of the basics. Everything was just capital all over the place, and it was all increasing. I was in the market in 2007, 2008, 2009, and saw people get hammered. I took a pretty good knock on the chin on my personal residence during that period. But I know fortunes were made in that time period. I don't know that we're going to have those same type of buying opportunities this go around. There's some different fundamentals in play right now. But those same fundamentals of real estate make it even that much more attractive to me. I have a little bit of money in the stock market. I keep a little bit of cash there. For the last several years, just the run up there has been phenomenal. I kind of got this little sense of FOMO of, okay, I can put some money to work there. That's even easier. And then, that all took a hit in the last several months. And I got reminded of why I don't like putting my money in the stock market. The fundamentals of real estate are everybody needs a place to live. Everybody's got stuff to store. It can certainly go down. There's clearly cycles, but you can't run away with it. It can't go to zero. It's insured. If the thing burns down, you've got some protection. It comes down to hard physical assets that do well in inflationary environments that can provide significant potential upside, even in those inflationary markets, even in bad economic cycles. As long as you can, respect the debt, make sure you're not in a place where you ever have to sell, then for me, I feel is a very safe place to be.
Okay, well, that's really cool. Now, before we talk about the selling part in the kind of deals that you do, can you explain from your perspective, and maybe I chime in from my perspective afterwards, why you would say it's helpful to be in this asset class in inflationary environments?
Yeah, as we generally are involved in deals that we refer to them as value add opportunities. You buy an underperforming asset, you go in there, you fix it up. And it could be underperforming for multiple reasons. It could be the property hasn't been updated. It could be just, not ideal management. And so you go in there and you optimize those elements. And then as you do so, one lease expires, you're able to bring up those rents to current market rates. And then in the commercial space, you are rewarded by an increased property value by optimizing or increasing the operating income, the net operating income. And so having that ability to go in there and bring the rents and the operations up to current market standards. Inflation is impacting rent, whether that's in a storage unit, whether that's an apartment. The ability to go in there and reset those rates as prices have been driven up from other market influences, in turn, increases the value of the property as well. Yeah, there are certainly other market factors in play, but you have significant control of the ability to make sure this asset to drive up the value of this property, force the equity growth through the optimizing the operations, and stay well ahead of inflation. So yeah, it's a significant protection on having a hard, solid asset as opposed to watching our money sitting in the bank account and without even doing anything to it, it's worth less than it was 30 days ago. It's worth less than it was a year ago. Our cash reserves have all taken a 10 to 15% hit in the last 12 months. It's just been brutal to see what a dollar can buy today versus 12 months ago. but yet the value on my real estate has softened that blow.
Yeah, exactly. And that last part is how I lately try to frame this for people who don't necessarily use that language or the terminology all the time, or may not necessarily be that much into, how do financial assets and valuations and stuff like that actually work. I lately oftentimes try to describe it this way. If you have, let's say, just for easy calculation, 10% inflation, and you look at anything. You look at a car, you look at something you buy in the store, you look at a house. That thing in and of itself has not really changed. The tomato that is beautifully organic, grown in on the farmer's market stand is still that tomato. That renovated property that you just mentioned, Brad, is still that renovated property with all these improvements in it. The thing is that the money has lost the ability to buy that tomato or that house or that car for the same number of dollars because of inflation. So it's the value of the money that, like you said, is going down. So you actually, for the same good, whether it's a house, a tomato, or a car, you need more of those to get the same value. Right. And then on top of that, there are two things I believe are important in real estate is supply and demand. Right. And that's probably the biggest driver why we have been seeing these increases in price with or without inflation, because we've seen the price appreciation in 2019, 2021, when inflation was like 1%, 2%, 4%.
Right.
And that is because demand is high, like any good, right? Like if there are plenty of people who want it, and there's only so much to go around, which for all kinds of reasons, we have way too little real estate, especially new build, going around right now. So that's one thing, that people are just bidding up the prices in that sense. And then the other thing is, I believe what you were touching on, the valuation, right? Like if I say, okay, I live in an apartment complex with 100 other tenants, but it's not really been renovated. The kitchens are old, the appliances are old, the floors are kind of stinky, the common areas are not really appealing. Well, then I am not as much in competition with anybody who wants to live in a nicer place. And then Brad comes along and says, oh, okay, I buy this thing and make it beautiful again. I remember when I was younger, there was this TV show when they did a total remake or something like that, where they took somebody and gave them a spa treatment, a haircut, a new clothing, a fitness program and stuff like that, right? That's kind of what I always think about when you guys are taking on a project and making it beautiful again, because now anybody who says, I would like to live in a beautiful apartment or a beautiful condo or so, is now also interested in those. And obviously you kind of create more demand, but also everybody would acknowledge, if I have a brand new kitchen, nice new floors, nice new common areas, it's more value. Right. Regardless of inflation, right? So I think that the thing really to understand in inflation is, it's not that something gained in value, it's that the dollar or whatever currency you use lost in value.
Right.
And so therefore you need to use more of the lesser valuable dollars or yen or euros or whatever it is to get the same thing.
I walked into Costco last week. We've been buying our avocados there for years, and I don't remember the last price increase. It's been $5.99 or whatever, $5 for a bag of avocados for years. Walked in there last week, and all of a sudden they want $12 for it or $11 for it, and double it. So it's a real punch in the face. I mean, in real terms, the cost of living has increased significantly. I feel horrible for the first-time home buyers. For people renting on the budgets, it's tough. There's so much demand, so little supply all the way around, and then you get COVID and supply constraints, supply channel constraints, I should say, and hiccups. You need some way to make sure that your income, your values, your net worth is keeping up with that increase of how much it costs to buy that avocado today. And real estate is a great way to do that, especially in real estate where you can force the appreciation through improvements to the property or improvements to the operation. And yeah, today, I remember as a kid, a college kid, a crappy apartment with 5 other guys was fine, right? But now we all want, the apartment renters, they want the dog park. They want a fenced backyard on the ground level of units. They want the Amazon lockers. They want a nice gym and a nice pool area, a great stainless steel kitchen and granite countertops. And if you can go in there and supply that in a cost efficient way, yeah, people are willing to pay. The renters are willing to pay for those improvements. And now by doing so, you increase the operating income of that property, and you can be rewarded on the back end when you go to sell that property.
Yeah, absolutely. And I think that's really the important thing. And I think it's important to, like you just did, Brad, to reiterate that this principle, taking something making it better so that its value increases and becomes more desirable works always, regardless whether we have high inflation, low inflation, high interest rate, low interest rate. That principle applies. The only thing, and I'm totally with you, whether it's first-time home buyers or even investors in general, is when the market of financials has been manipulated, resulting in a situation where whether you're an investor or first-time home buyer, you may now no longer qualify, even if you have a good job or anything like that, because the cost, not just in the price of the asset that you're buying, whether you're buying an apartment or house or anything like that as a first-time home buyer, but also the cost for the money through the interest rate increases has gone up to a point where I know in recent articles that a lot of people who had, for example, signed contracts for new build developments
Right.
basically had to cancel the contracts because their bank said, well, sorry, interest rates have basically doubled or even more than doubled, and you just don't qualify because we had you kind of like at the upper limit of what you could do when mortgage rates were like 2.9 or 3.5%. Now they're 6%, and it just doesn't work anymore. So I'm with you on that. The thing that I believe is really important for people to understand is if we go back to like March, April 2020, and everything was shut down.
Okay.
And the government basically said, okay, we're giving out money, we're printing money and giving out money for free. So if you had a company, not you and me who are actually working in real estate, where you actually have to create something, pandemic or not. But if you had a company and you shut down your company and you said, okay, we wait until the government lets us open again, and you're a publicly traded company, in the next 15 months, while this enormous amount of money was flooding the market, your company's shares increased in value by at least 30% for doing nothing. You didn't do anything. You didn't sell anything. You had no door open, nothing, and your value supposedly increased by 30%, which this is just another way to reiterate. It's not really that you got rewarded in value by doing nothing. It's there's so much more money that every individual dollar is less worth. But in real estate, we have a little bit of a way, I think we both agree, to take advantage of that situation because we have both all these mechanisms plus an enormous amount of demand and not enough supply, even if we wanted to. I believe in the single family market right now, if we were to put 5 million units on the market, assuming that people could qualify, they would be eaten up right away. Right, because there's so much demand. Now, we started out to talk a little bit about the difference between passive and active. So I'm sure you're burning to go into that a little bit and describe how you would, in your business, what you do for your customers, for your investors, how you describe it and what you would say the benefits and detriments to either side are.
Sure. Yeah. So, that was part of my journey. Up until 2017, I called myself very active. Buying the rental property, managing it, even hiring a property manager, still very active. Doing the fix and flips, incredibly active. I mean, that's a day job. We had our hospitality units, those vacation rentals, very active. And so then when I started looking at commercial and thinking about apartment complexes, mobile home parks, where do I want to go here? I started talking to brokers, commercial brokers, and getting on their buyers list. I want to see your deals. I'm thinking the idea of bringing in a team of investors here to participate in these and be on the front end as the active operator, but on a larger scale. And as I was doing that, I worked, talking to some different brokers, networking with folks in this space. I connected with some individuals in a group who were doing really well, partnering with those currently active and successful operators, but bringing new capital to them and helping them grow their business and expand their capabilities and the number of deals they could go take down. And again, light bulbs went off for me. Bringing dollars to these deals. I know how to explain these deals. I know where to go find these dollars. I feel like I can translate that well to individuals who want to participate in real estate but don't want to manage. They don't want to be at the front end. They're doing well already as business owners and entrepreneurs. They're doing well already as lawyers and doctors, but they want to participate in it without making it a huge distraction for themselves. I began developing my relationship with, again, currently active, successful operators and conversations with them. How can we work together to bring capital to your deals? They're all looking for capital. And that's what I focused on for the last 5 years, is really bringing in what we'd call limited partners or passive investors to these operators that I've been able to identify as these are the good ones. These are the good deals that I'm happy to take back to my investors and say, here's an opportunity in this market with this operator. Here's why I like it. I've been to this property. I've had lunch with these people, gone through the business plan and due diligence line by line here, and present this opportunity, for both myself to invest capital with these operators, but then go to my network, go to my investors and say, here's an opportunity for you as well to participate in these types of returns. Certainly, the active folks have an opportunity for maybe some bigger pops of cash, we could say. Being on the front lines, they get rewarded for sourcing and managing and executing the sale of the property. But it comes with full-time involvement. The flip side of that is you can generate really amazing returns as a passive investor without having to do anything and be rewarded for just providing capital. And so it's just simply a matter of helping these investors identify who are the good operators, what are the good deals, what makes a good deal, and be rewarded for bringing those opportunities to that group. And I have really enjoyed that role. That's not to say I'm never going to go out and buy my own asset. I still have my own handful of rentals that I still run at this point with property managers in place. As it makes sense, I sell those off and I take that money and plop it right down into a syndication as a limited partner because I enjoy that. And the returns there have been, in many cases, equal or not better than what I was generating on those rentals myself. So yeah, that's a kind of a long-winded answer to your short question there. But
no, that's perfect. And that helps. Yeah, that helps our audience to understand a little bit more. Now, if somebody is listening to our conversation and says, maybe not for all my investments, but since, obviously certain investment groups, like we discussed earlier, are not really doing so well anymore. And I had actually advised most of our investors who had like 401ks and other like stock market instruments and stuff like that, right around the time when Jay Powell announced that they're going to go on like quantitative tightening and increasing interest rates to basically say, okay, the writing is on the wall.
Right.
You should get out of it or at least secure your gains, right? Like if people say, okay, I put X amount in and it has grown so much, then at least secure those gains and then use them for something that is not as much affected by these coming changes. So if anybody has done that or has otherwise some assets that need a home, can you describe a little bit if someone were to say, Brad, you're talking about your investors. If I wanted to become one of your investors, what criteria do I need to meet or how much do I need to bring to the table? A little bit along those lines.
Yeah. When we talk about syndications is just a fancy word for a group of people coming together to invest. It's a group investment. And in that scenario, they are deemed as securities. And so, of course, there's a ton of legality around how these securities can be presented to individuals. Also depends on what type of security this asset is. So there are generally a few qualifications. There are some of these syndications that are structured so that I can bring in investors who don't meet an accredited investor definition into them, and we can unpack what that means. But in those scenarios, it just means me and that new investor, we have to have a pre-existing relationship, a very poorly defined term, but it does mean I can't meet you on Monday and take your money on Tuesday. We need to know each other for a little bit. I need to have a good sense of where you're coming from. We generally define that as a couple of meetings. We're going to go have coffee together. It might be a virtual coffee. Meet you on January 1. I could present a live deal to you beginning of February. So it's not a long process, but to be safe, we want to have some cooling off time where we start to explore this idea of, does this interest you? Here's what a past deal looked like. Does this type of thing interest you? We've known each other for a month or more. We've had a few interactions. Now I can present a live opportunity for you. And again, that's in those deals that allow for non-accredited investors. The other alternative is these deals only allow accredited investors. That means I don't have to know you. I just have to have you verify that you're accredited. That means you've got some cash. You can afford to take a punch on the chin. This isn't your only source of capital right here. And in those deals, I could blast it on Facebook, I can blast it on Twitter and meet you on Monday and take your money Monday afternoon into that deal as long as you meet that accredited investor definition. In either scenario, most of these deals do have a fairly high minimum. It's more often than not, it's around $50,000. And then, it just comes, whether that's a deal that allows for non-accredited or one that requires the accreditation, it just depends, that determines what the timeline is like. But it really is for any individual who has that capital. They're not satisfied with what they're getting in other places. They like the idea of real estate. They're not really excited about the idea of changing light bulbs, finding tenants, unclogging toilets, or going out and hitting the ground to build up relationships with the commercial brokers and putting their own syndication groups together. They've got the capital to deploy, and we help educate what makes a good operator, what makes a good deal, what makes a good market. And boy, if this speaks to you, we can put that capital to work and generate some phenomenal returns together.
Okay, yeah, that's great. That's a great summary. Now you said can afford to take a hit on the chin. How does a hit on the chin look like practically? Like if
Yeah.
let's say you and I had talked, we know each other for a while, I'm accredited, you're probably accredited, and I say, okay, I can do 50 grand. How would a hit on my chin actually look like?
Well, ideally, there's no hit on the chin.
Ideally,
Yeah.
right.
But that, accreditation status, accredited investor status, is basically the SEC saying you're sophisticated, you're smart, you can go make your own investment decisions. These are private investments. The SEC is saying we don't have a ton of oversight with how these things go. Oversight, sure, but it's not the same as a public stock. The financials aren't as easy to access. The liquidation is not,
Right.
there. And so the SEC is saying, okay, Mr. Hotshot, you're accredited. You've got some cash in the bank. We deem you as sophisticated enough to go make your own, to invest in private deals and do your own sufficient due diligence. Then on our side, it's okay. We don't want to give you a hit on the chin. We want to give you, amazing returns.
Right.
As far as my experience, I've been in multiple syndications, both as part of the general partnership as well as just as a limited partner. And my very first one didn't go great. I went in as simply a limited partner. We put $50,000 in there. Not an ideal market and not an ideal operator. I take from that lessons learned of what not to do.
Yeah, right.
We were a couple hours south of Houston. Deep value add. This was a rough property. It needed a lot of work, and there was enough space there to build some new units as well. And so we got going on there. In the first 8 or 9 months, things were fine. We were getting our monthly distributions, and then we had Hurricane Harvey. I think it was Harvey came through there. All that new construction that had started got blown down by that storm. And trying to get things reapproved and cleaned up, it turned out the zoning wasn't right. And then finally got a year of trying to deal with zoning issues. Got some offers on the table, and I think at this point we've had 3 or 4 fall through. And so this deal that was meant to be, I think we were supposed to be in it for maybe 2 years. I'm still in it. 4 or 5 years later. That's my hit on the chin. I'm still getting my return. I haven't lost money. I haven't lost that 50K. In that deal, I went in as was called a Class A investor, meaning I just got my flat 10% fee. That's still accumulating. Sooner or later, that property is going to sell and we'll be fine. But it was,
Right.
man, I could have put that same capital to work much more efficiently with other deals since then, with ideal markets, with ideal operators, with ideal properties that didn't need that much work. And so, call that a hit on the chin. These are protected assets. At the end of the day, there's something physical you can go put your finger on and say, man, this is it. This is a thing I own. It's insured. It can't blow away. Most of it can't blow away. Nobody can take run away with this deal or this asset and then disappear with it. So it's
Yeah, and that's actually a good point I've been meaning to ask. So you kind of built the perfect bridge. When you say there is an actual asset there, can you say in a few words, what does a limited partner actually own with their money?
Yeah, that's a great question. So a limited partner is a member of the entity that is going to go buy this asset. So if I was going to go buy a house and I wanted an investor to go in there with me, we're going to form an LLC, we're going to form some type of an entity and both participate in the ownership of this property. When we're talking about larger syndications like this, it generally breaks down into, or it does break down into, those who are actively going out and acquiring the property, managing the managers, going to handle the sale of the property. Those are the general partners. And then the limited partners are simply providing capital. They have no say whatsoever in what color of paint this is we're going to use here, what the rent should be next month. They have no direct involvement in the day-to-day operations whatsoever. And in exchange for that, they have no liability. So that's where the limited part comes in. You have limited liability. You're a limited partner. You simply provided capital. The only thing you stand to potentially lose is the capital you invested as a limited partner. But you own your percentage of that deal. You are a member of that entity that owns that asset. And then it's a percentage of, based on who's contributed what dollar amounts to purchasing that property. So you are an owner. You're going to get a K1 at the end of the year. You're fully involved.
Right. So basically, if I try to paraphrase and translate that a little bit, as a co-owner in that company, in that LLC, let's say the LLC puts out 10,000 shares or breaks the value into 10,000 equal pieces. And the general partners, I don't know, keep 40% and 60% are available to investors. And I say, okay, I buy 10% of those shares, then I own 10% of that LLC. And if it performs as the prospective and the project basically anticipated, I get my benefits out of the increase in value, and if there's rent income and stuff like that, I get that, right? Is that a fair description of what I'm actually? I think I understand it also that way, because you said it's a security. It's kind of like shares in a company. It's just not a public company on the stock exchange. It's a company that is owning the asset, owning the apartment complex or whatever it may be.
Yep, you're exactly right. So in that scenario, you own 10% of the company, 10% of the proceeds. There are, we could get a little more complex in talking about what those splits are and how, equity waterfalls and capital structures.
Yeah, but that's Brad, that's for the time when anybody who
That's
is now
right.
getting
Exactly.
their mouth watered from the podcast, when they say, "I got to talk to Brad to find out about those
There you
details,"
go.
and
Yeah,
then
we'll dive into
you
those
can
details.
sit down and have the virtual coffee and do all that.
That's right. But yeah, so you're going to get your 10% returns. You're going to get a K1 at the end of the year as a member of that entity that shows those returns, and you are an owner of those securities that it's tied to that asset.
Okay, that's very cool. Yeah, I appreciate that explanation. Cool. I think we covered that pretty well. So if anybody is interested, we're going to obviously make Brad's information available if anybody likes to contact him and say, hey, tell me what kind of opportunities you have, and maybe the waterfall and all these other cool details. Now, as we come to the end, I always ask 2 questions to every guest. So I want to ask them to you as well, Brad. One is, if you could meet anybody, right, that somebody you idolize, who would that be and why?
Yeah, that's a good question. There are many. I think like many folks, I think about, man, it would be so fun to have a conversation with an Abraham Lincoln, an Alexander Hamilton. Man, I'd love to get some more insight into their brain. I'm going to throw one out that I'm sure has not been mentioned by any previous guests, but is a personal hero of mine, is a man named Joseph Smith. Lived maybe 200 years ago. The guy went through a ton of crap, dealt with a ton of stuff, and tried to accomplish a lot of good. I would love to go back and have a conversation with him.
Okay. All right. Yeah, that sounds cool. And the other names would be cool too. And then the last question is, if you had a time machine, you could go forward, backward, anywhere you want to, where would you go and why?
I've always been the Roman Empire. I guess I'd have to keep on bouncing around because they lasted for a while. But from the start of that to the end of that, in between, their conquest, their expansion, their decline, boy, that would be amazing to have a front row seat of that. I do like history. That was my favorite subject in high school. I couldn't figure out how to make a career out of it, but I've always enjoyed going back, and I love memorizing the dates and the events and the names. It'd be amazing to
totally. I think that's something that we may have or probably have in common, because I like history too, especially the more ancient history, like from the Egyptians and stuff like that. So Brad, the advisor to the emperor, I can see that.
So, there you go. That's a dicey job.
Well, it's better than, most of the other ones I can see, like if you have to go with the gladiators, or if you have to go out with the conquerors or stuff, I think I would rather be the advisor to the emperor.
Yeah, there you go. That's
a little safer, Brad.
I grew up in Western United States. So then I go back and visit New York, and I see these 200, 300-year-old graves and churches. Wow, this is so old. And then I go to Europe. I remember for our honeymoon, we went to Italy. And, seeing all this old stuff in Italy was just amazing, thinking about how old this stuff was. And then as part of that is all of a sudden here's this obelisk that the Romans stole from the Egyptians. And that obelisk was like 2,000 years old when the Romans stole it. Like, holy, it's mind blowing how, going back and thinking about these different, like what old means.
Yeah, absolutely. I still remember one of the big fascinations when I first heard that in history class was when some archaeologists found those plates from Hammurabi in 4 or 5 different languages that ultimately allowed to decipher the hieroglyphs, right? Because it had one language of the different ones that were on that plate that they actually knew. And so then they realized, oh, this is a translation for these different. I read that and looked at the pictures for hours. It was so fascinating. Yeah. So
yeah, absolutely.
Yeah, I mean, if I had the time, I would come with you on that trip.
Hey, it's a time machine.
All right,
we can make the time.
Yeah, exactly. We can basically fly faster than the speed of light.
That's
exactly.
right.
So, well, coming to the end, I want to give you a little bit of a chance. If somebody, I meant that seriously, if somebody says, hey, this sounds really interesting, maybe I want to tip my toe into this syndication investment opportunity, what would you recommend? How should people get in touch with you?
Our website is, if somebody's really ready to start that conversation, sugarhouseinvestments.com is the best place to connect with us. Sugar House Investments. That's where you can kind of see some of our past deals, jump on our new deal alert email list so you can see these upcoming opportunities. Raise your hand at ones that look interesting and we can dive into details. Recently moved from Austin to Boise. I love talking to people about this. So if anybody in the Boise area wants to get together for real coffee, we can do that as well. Yeah. But I do like hanging out on Twitter. I discovered Twitter during COVID. Like, hey, there's a ton of good real estate discussions going on Twitter. So I'm at Brad Shep on Twitter. And so people want kind of casual conversations, I'm hanging out there during the day as well.
All right. Well, that's really cool. And we put your Twitter and your website and all that stuff in the show notes. So people who listen to us and then maybe want to go on the computer or into the podcast on Apple or Spotify or anywhere, you can find it there. So, Brad, I really want to thank you to making the time. I know we went a little over, but it was a vigorous conversation. And I think a lot of people are looking, okay, what do I do now that I don't do stock market or that kind of stuff anymore?
Yeah, well, I appreciate it. I'm certainly happy to go over a little bit of time. I appreciate the opportunity and thank you for having me on.
Yeah, good luck in Boise. And also, I'm sure you're still offering investments in other places around the country. And maybe we can do it again at some point.
All right, would love to. Yeah, I look forward to it.
Thanks for listening, and I hope you enjoyed today's episode of the Ideal Investor Show. More info and the links we mentioned during the show are in the show notes, or you can go to our website at idealwealthgrower.com and sign up for the Apple Podcast link. And if you like to talk to me, sign up for a strategy call. Hopefully you want to share what you learned with your network and bring more people in. We are really eager to hear your comments. And until next time, be well, stay safe, and ciao.